saying Monday seems like so long ago.
Yeah, what a day. And when the market was tanking, your inner voice was probably, if you bothered to look at the stock market, yelling, sell!
That's right.
Now, if you listen to that inner voice, though, you probably missed the Dow's biggest one-day point gain in 5.5 years, which happened the next day.
And herein is the frustration in trying to trade and time markets. Then on Wednesday, the markets tumbled again, giving back 75% of the gains that they were made on Tuesday. You're following? These swings are a great reminder that you cannot time the market. Doug Flynn is a certified financial planner with Flynn Zito Capital Management. He's here with more. You know, sometimes we think we are. We look at a big down day, we say, okay, I've had it. I've ridden these swings for 2 months now. I'm getting out. I'm selling my ETFs, or I'm going to get real conservative in my 401k, and then you miss a big day the next day.
Yeah, that's pretty common, and that's getting you away from your long-term plan. So if you're talking about retirement money or money that you put in place to not be needed for a very long time, you completely want to ignore all those day-to-day fluctuations.
Yeah, you shouldn't even be involved in things that are going to, you know, somebody asked me yesterday, how do you avoid losing sleep at night? Well, don't be in investments that are going to make you lose sleep at night. We've talked about risk tolerance in the past. Everybody's got one, and you can invest in a way that generally puts you there.
That's right, and your short-term money should be invested very differently than your long-term money.
Right.
So your short-term money should probably not have ever been in the market, but people get too wrapped up in trying to take advantage of that. And your long-term money, if it is, you can't worry about it, especially if you're adding, you're taking advantage of those swings. But, you know, there's a sentiment that goes on up and down in people. It's a very natural human emotion that people feel at different times in the market.
I wish there was a gene for buying low and selling high, and I wish I had that gene, but I don't. And, you know, history has proven that I don't have that. But I'm like a lot of other people. When you look at the trajectory of decision-making, you see people making big mistake number one.
That's right, and the mistake number one is to completely get off your game of your long-term plan. And we'll hear it from clients will call up and express some concern at the low point. Listen, I should have never gotten in here. I'm not comfortable with it. And you can see here, this is a pretty common human emotion cycle. When the market's down, they're feeling never, and then as things get up, they go, well, maybe.
This goes for stocks. It can go for a lot of other things in life,
it goes for all sorts of things in life, right. And right when you're at the top, everybody
feels good about getting in, and that's exactly the worst time. And then as the cycle goes back down, people start having regrets and buyer's remorse. But none of that should enter into the equation long term if it's your long-term money, and that's the trick.
And we've talked about people, clients of yours, and I'm sure they're all over the place, where right at the end of that chart where we show, you know, people thinking they were wrong, and then they bail out almost at rock bottom sometimes.
Yeah. We almost, we have a little, we keep track of when people call to say, you know, this is it, I can't take it anymore. Just when you can't possibly take it anymore is typically the time when it turns around. So, no, you don't want to make those adjustments because you're going to make a big mistake. And if you do sell out, you're going to miss a couple of those days like we've had in the last 2 weeks. And if you miss just a couple of those days over any period of time, you'll give up the majority of your return.
And this is what it means to be fully invested in the market. If you pull out, and you can look at the numbers from S&P and from a lot of different gauges, but over a 10-year period, you pull out for the 20 best days because you got crazy and pulled out right at the bottom, you've lost a lot of money.
That's right. This is a 10-year period from 1997 to 2007, just ended. We're not talking about the 20 best days a year. We're talking about the 20 best days in 10 days.
That's right.
10 years.
Through thick and thin.
And in fact, 2 of those days, this doesn't go through most recently, but 2 of those days could be in the last week.
Yeah.
Right.
But this is the point. Even though the return on the market wasn't spectacular over the last 10 years, if you were out and missed just on average 2 of the best days per year, your return goes from positive to negative.
It's human nature to catch the worst days and miss the best days, you know, if you're trying to time the market. And that's why some people look at charts, and that's why people make careers in this, because humans unfortunately repeat history, and that's why markets continue to go up and down.
How many mutual funds should the average person have in their 401k or their IRA?
Probably about 10 to 12 to be diversified properly. Yes, if you want all of the different asset classes and different styles. And if you do that, you do want to do tweaking and you want to re-examine your risk level. But other than that, unless something has drastically changed in your financial situation in the last week or month, where you've lost your job or something like that, unless something dramatically has changed, you should not be making changes to your long-term portfolio right now. That would be a mistake.
And for somebody watching, for starters, should they just even that out, the 10 or 12, so they just distribute it evenly?
Well, you could get into where you probably should have a little bit less small cap, a little less value right now, probably a little less international than we have had, things like that. But generally, evening them out is better than doing, you know, all into one area. That's for sure.
It depends on, you know, your risk tolerance, where you are, how close you are to retirement, and all that kind of stuff too. But bottom line is diversify, keep your head on straight. Don't don't be pulling out of the market after a big move one way or the other.
Because you will not know the right day to get back in. That's the trick. And possibly you could get back in when it's higher.
All right, Doug
good
Flynn.
to talk to you. Thank you. And by the way, CNNmoney.com is following this. If you go to cnnmoney.com/issue1 or just cnnmoney.com, they've actually got a lot of these sort of ways of calculating your risk and risk tolerance and things like that. Do that. It's worth a few minutes.